Gold futures for April delivery touched $5,177.60 per ounce on Wednesday. That number, recorded by U.S. exchange data and reported by Reuters, is not the headline. Curious. The headline is what happened in the 72 hours before it, because what we witnessed between February 28th and March 5th of this year was not a standard safe haven trade. It was a simultaneous disruption of both the paper price of gold and the physical supply chain that delivers real metal to real buyers across 3 continents. Surprised. Those two things have never broken in exactly the same direction at the same time for this long. Understanding why that matters and why it changes your read on everything that follows is what this video is about. By the time you finish watching, you will understand 3 things that most people covering this story have not connected. First, why the price spike to 5,176 is actually the less important data point, and what the physical market data coming out of Dubai, India, and London is telling you that spot price alone cannot. Second, what a specific disruption to a single transit hub, one that handled roughly 20% of global bullion flows in 2024, means for the structural relationship between paper gold markets and deliverable physical metal. And third, what the Bank of England's suddenly frozen rate cut calendar tells us about how this conflict is landing on a UK financial system that was, until 10 days ago, widely expected to be cutting interest rates this month. These are not separate stories. They are the same story told from 3 different angles. The piece that nobody is assembling is what they look like when you put them together. Let's start with what is confirmed and dated. On February 28, 2026, coordinated United States and Israeli military strikes targeted Iranian strategic and military infrastructure. The scale and nature of those strikes triggered what can only be described as a cascading sequence of market events. According to Kitco spot price data cited in a Goldman Sachs commodity desk note dated March 1, 2026, gold had already risen 2.3% from the pre-strike baseline, trading near $5,246 per ounce by the morning of that day. That Goldman Sachs note, authored by Michael Stryven, Samantha Dart, and Yulia Jestkova-Grigsby, was structured around oil price scenarios, not gold, but the commodity desk acknowledged a corresponding safe haven response in precious metals embedded in the risk premium calculus. Gold surged 5.2% in early trading on March 1st alone. By March 3rd, something more complex was happening. Reporting by Bloomberg and subsequently confirmed by Reuters described what was physically occurring in Dubai International Airport. According to that Bloomberg report, published March 3, 2026, entitled "Grounded Flights in Middle East Stall Gold Flows from Dubai," an unprecedented wave of Iranian missile strikes had led the United Arab Emirates to partially close its airspace and suspend commercial flights. Representatives from multiple trading and logistics firms told Bloomberg their metal shipments to and from Dubai had been paused indefinitely. Flightradar 24 data cited in that reporting counted more than 12,300 flights canceled globally in the immediate aftermath. Emirates Airlines, the world's largest international carrier by international passenger kilometers, extended its suspension of scheduled flights until Wednesday night. Etihad Airways prolonged its halt until Thursday. Gold and silver carried in the cargo holds of passenger aircraft, the dominant, lowest-cost method of moving physical bullion between continents, simply stopped. This is where the data becomes structurally important rather than merely dramatic. The UAE is not a peripheral node in global gold logistics. According to the Money Metals analysis published March 9, 2026, drawing on trade flow data, roughly 1,892 tons of gold flowed through the UAE in 2024. As a proportion of global bullion transit, that figure represents approximately 20% of worldwide flows. The UAE serves as a refining hub. Raw doré bars, containing between 60 and 90% gold and mined across Africa, arrive in the UAE, are processed into market-standard bullion bars, and are then exported primarily to India and other Asian markets. It also serves as a redistribution conduit for Swiss and London refined metal heading east. Both functions stopped at the same moment. Philip Newman, managing director at the London-based consultancy Metals Focus, was quoted directly in Bloomberg's March 3rd report. Premiums for bullion in Saudi Arabia rose significantly on Monday, which he described as an indication of worries about limited product availability. One of India's largest gold dealers, also cited by Bloomberg, said that several cargo shipments have been delayed or stranded, leading to short-term tightness in the availability of physical bullion in India. India is the world's second-largest gold consumption market. This was not a theoretical tightness in a secondary market. This was physical bullion unavailable at any price to the largest retail gold market in the world outside China. Now here's the counter-argument that serious analysts are making, and it deserves to be presented fairly before we address it with data. The argument goes like this. Gold spikes during every major geopolitical escalation, It almost always gives back a substantial portion of those gains once the immediate shock fades, and what we are seeing is a classic emotional overshoot rather than a structural dislocation. The 2022 Russia-Ukraine escalation saw gold gain 8.2% in the first month before retracing. The Gulf War of 1990 saw a comparable sharp rally that normalized relatively quickly. At its core, the counterargument holds that geopolitical risk in gold is a trade, not a thesis. That is a reasonable and historically grounded position. It deserves a serious response. Here is the data that distinguishes this episode. In every prior geopolitical gold spike, the physical delivery infrastructure remained intact. In 2022, London was fully operational. In 1990, the global bullion routing system was undisrupted. What is happening right now involves the simultaneous closure of the world's most critical single transit hub for physical metal, the effective closure of the Strait of Hormuz affecting 20% of global crude oil flows, according to the U.S. Energy Information Administration's own choke point data, and an oil supply disruption that consulting firm Rapidan Energy, in analysis, circulated to clients and reported by CNBC on March 9, 2026, described as the largest in history, nearly 3 times the size of the 1973 Arab oil embargo in terms of percentage of global supply disrupted. Those 3 factors occurring simultaneously create a different underlying condition than a standard fear trade. The counterargument holds if the infrastructure disruption is short. It weakens materially if Dubai's airspace remains restricted for weeks rather than days. Here is what nobody is fully assembling in one place. On March 4, 2026, a detailed physical market report published by USA Gold drawing on Financial Times sourcing described the specific economics of the Dubai corridor with a precision that most outlets missed. According to that FT reporting, individual passenger aircraft cargo holds were routinely carrying up to 5 tons of gold per flight, consignments worth as much as $830 million per aircraft, mined in Africa, refined in the UAE, and routed primarily to India. Traders described the situation to the FT in plain terms. Nothing is moving anywhere by air right now. The consequence of that stoppage was not symmetric. Gold that was stranded in Dubai was being sold at a discount of approximately $30 per ounce below spot, according to Business Today's March 6th report citing Bloomberg data, because sellers in Dubai could not move it and needed liquidity. Meanwhile, buyers in India and other Asian markets were facing the opposite condition: physical unavailability at any price, with India's domestic gold premium flipping from a $50 per ounce discount to London parity within 48 hours. That divergence, the same metal, priced differently in different places because the logistics of connecting those places had collapsed, is the signal that distinguishes this episode from a standard fear trade. The paper price in London and New York reflects one market. The physical availability in Mumbai reflects another. The gap between them is not a theoretical arbitrage. It is a real, documented, named source constraint confirmed by the managing director of Metals Focus, by India's largest bullion dealer, and by independent FT trade reporting. The European Business Magazine analysis published March 3rd, citing direct industry sources, went one step further. Traders unable to fulfill physical delivery obligations may be forced into cash settlements, distorting pricing mechanisms. Cash settlements in a bullion market mean that the promise to deliver physical gold resolves in money instead. That is not the same thing. There is also the Bank of England dimension, and it matters for a UK audience in a way that most American-centric coverage is ignoring entirely. Before February 28th, the Bank of England's base rate stood at 3.75%, having been reduced 4 times during 2025 as UK inflation fell toward 3%. Governor Andrew Bailey had described the return to the 2% inflation target as, in his words, essentially secured. Market traders were pricing an 86% probability of a further rate cut at the March MPC meeting. According to reporting by the UK publication Business Matters, and confirmed by CNBC on March 9, 2026, those odds had collapsed to less than 5% within days of the escalation. Less than 50% probability was being assigned to a cut even in April. JP Morgan's chief UK economist Alan Monks, in emailed analysis reported by CNBC, stated precisely, BOE cuts are possible in the first half of 2026, but March is off the table and April requires a clear calming of geopolitical tensions. Bloomberg reported on March 9th that the Bank of England now faces the prospect of UK inflation rebounding to as high as 5%. UK wholesale gas prices had surged by around 40% in the days following the escalation, according to Business Matters' March reporting. The rate-cutting cycle that was the baseline scenario for 1.8 million UK mortgage renewals in 2026 has been suspended by a geopolitical event. The connection to gold is direct and mechanical. Gold is a non-yielding asset. It competes for capital with interest-bearing instruments. When rates fall, the opportunity cost of holding gold falls, and gold becomes relatively more attractive. When rates are expected to stay high for longer, because a supply shock is generating inflation that central banks feel they cannot simply accommodate, the traditional safe haven bid in gold exists in tension with that rate environment. That tension was visible in the price action itself. According to CNBC's March 3rd reporting, spot gold fell 3.6% on the day to $5,137. Even as the geopolitical situation worsened, precisely because a stronger dollar and higher bond yields, both consequences of inflation fears, were mechanically creating headwinds. Bob Haberkorn, senior market strategist at RJO Futures, described the move as a flight to liquidity, a flight to cash. Peter Grant, vice president and senior metals strategist at Zahner Metals, offered the assessment quoted by Reuters that macro fundamental factors remain broadly supportive, but acknowledged that there is risk that volatility continues. The LBMA's own 2026 forecast survey had predicted gold would reach $4,400 per ounce as a quarterly average by mid-year, with a high-case scenario around $4,150. Events moved roughly 18 months ahead of the most optimistic institutional projection. Let's place this inside a historical frame, because the data is both instructive and honest about its limits. The closest structural parallel is not 1990, but 1973. The 1990 Gulf War, referenced by multiple Wall Street analysts in recent days, saw oil prices roughly double from $17 to $30 per barrel before coalition action and strategic reserve releases stabilized the market. The S&P 500 fell between 16 and 18% and then recovered sharply once the conflict concluded. That precedent applies to 2026 if the Strait of Hormuz reopens quickly and the conflict remains geographically contained. According to Rapidan Energy's analysis reported by CNBC on March 9th, the current disruption represents roughly 20% of global oil supply disrupted for 9 days, already more than double the previous record set during the Suez Crisis of 1956 in terms of magnitude and duration combined. The 1973 Arab oil embargo disrupted approximately 7% of global supply. The 1973 parallel applies if the closure proves sustained, and Saudi Arabia and the UAE, which collectively hold most of the world's swing production capacity, remain unable to reroute output because they too are geographically affected by the conflict. The Congressional Research Service's analysis on Hormuz, citing the U.S. Energy Information Administration, is clear. Saudi Arabia's East-West Pipeline and the UAE's Fujairah terminal together offer roughly 3.5 million barrels per day of bypass capacity, insufficient to offset a full closure scenario of 20 million barrels per day by any measure. The 1973 parallel does not map perfectly onto 2026. U.S. shale production provides a partial buffer that did not exist 50 years ago. Strategic petroleum reserves globally total approximately 1.5 billion barrels, providing roughly 75 days of coverage for the disrupted volume, according to Rapidan analysis. The G7 was reportedly in discussions about a coordinated strategic reserve release as of March 9th, according to CNBC reporting, though France's finance minister Roland Lescure confirmed no decision had yet been taken. Where the 1973 parallel does hold is in the stagflation dynamic, central banks facing an energy price-driven inflation surge while growth slows sharply, leaving them unable to cut rates to support growth without risking inflation expectations becoming unanchored. That is the precise environment in which gold's role becomes structurally supportive rather than merely reactive. There is also a UK-specific historical note worth including. In 2025, early in the year, LBMA gold lease rates, the cost of borrowing physical gold using the London market, spiked to as high as 5% at their one-month tenor, according to a World Gold Council analysis published in February 2025 and drawing on Bank of England and LBMA data. That spike was driven by the U.S. tariff arbitrage trade that saw gold airlifted from London and Switzerland into COMEX vaults in New York. Registered COMEX inventory peaked at 43.3 million ounces in March 2025, a 153% increase from the November 2024 baseline of 17.1 million ounces, according to analysis published in January 2026. By December 2025, registered inventory available for delivery had fallen back to approximately 10.1 million ounces, a 25% decline from the March peak, even as prices surged to record levels. That means the physical delivery buffer within the COMEX system entered 2026 already compressed, before the Iran escalation added an entirely separate physical supply chain disruption on top of it. Here are the 3 specific data points to watch in the next 48 to 72 hours, stated precisely. The CME Group publishes its daily gold vault report after markets close each evening Eastern Time. Watch registered inventory specifically, not total or eligible, but registered, which is the metal with warrants attached that can actually be delivered against futures contracts. If registered inventory falls below 9 million ounces in the next 2 sessions, that would represent a new post-pandemic low for deliverable supply at a moment of elevated demand and would be structurally meaningful. Second, the Bank of England's Monetary Policy Committee meeting, scheduled for later this month, will publish its minutes. What to watch is not the rate decision itself. The market has already removed any expectation of a cut, but the language around the inflation projection. If the MPC revises its February forecast of a return to 2% target by April 2026 upward to 4 or 5%, as Bloomberg's March 9th reporting suggests is possible, that removes the rationale for any rate cut through at least mid-year and provides a structurally hawkish backdrop that will continue to create volatility in gold's relationship with the dollar. Third, and most immediately actionable as information rather than prediction, watch whether Emirates Airlines and Etihad publish updated flight schedules for Dubai cargo operations. Each day of continued suspension extends the physical supply dislocation in Indian and Asian markets. Philip Newman at Metals Focus confirmed that Saudi premiums were already rising after just 48 hours. A prolonged suspension of a week or more, according to European Business Magazine's analysis, risks forcing cash settlements on physical delivery contracts that cannot be fulfilled, a mechanism that would distort the paper-to-physical price relationship in ways that have historically preceded disorderly price action. To summarize the 4 central findings of this video, gold futures for April delivery touched $5,167.60 per ounce on Wednesday, March 4th, according to Reuters, and spot gold traded at $5,166.75 on the same day, not because of speculation alone, but because a physical supply chain disruption in Dubai simultaneously reduced the deliverable metal available to the world's largest physical consumption markets. Dubai handled approximately 20% of global bullion flows in 2024. That corridor has been operationally closed since February 28th. Second, the disruption to gold's physical supply chain is structurally different from prior geopolitical gold spikes, because in every prior episode, the transit infrastructure remained intact. The paper and physical markets are telling different stories. Gold available in Dubai at a $30 discount while India faces unavailability at any price. And that divergence is confirmed by named market participants, including the managing director of Metals Focus. Third, the Bank of England's rate-cutting cycle has been frozen by this conflict. The 86% probability of a March cut priced before the strikes has collapsed to under 5%, as reported by CNBC on March 9th. UK inflation faces a potential return to 5%, according to Bloomberg, driven primarily by energy price pass-through. That creates a structurally complex environment for gold, supported by geopolitical demand but facing headwinds from a stronger dollar and delayed rate cuts. Fourth, the historical parallel that best fits the current supply-side shock is not the 1990 Gulf War, which resolved quickly, but elements of 1973. Specifically the stagflation dynamic, in a world where swing production capacity is geographically trapped behind the same choke point that has been effectively closed. Rapidan Energy described this as the largest oil supply disruption in history. That assessment, if it holds for weeks rather than days, reframes the macroeconomic backdrop for every asset class. The data, taken together, points in one direction. The conditions that would allow gold to retrace meaningfully, a rapid reopening of Gulf airspace, a quick resolution to the Strait of Hormuz closure, and a return of Bank of England rate expectations to pre-February 28 levels, are not currently in evidence. That is not a price prediction. It is a directional read based purely on the verified data presented in this video. One question for the comments. Given that the physical supply chain disruption and the paper price spike are now running in parallel, at what point does a sustained gap between Dubai discount pricing and Indian physical scarcity force a structural repricing of how gold's paper market actually values deliverable metal? Think carefully before you answer. It is not a simple question. Thank you for watching. This video is for educational purposes only and does not constitute financial advice. Every source cited in this script is linked in the description below. Figures from CME Group, Goldman Sachs, Metals Focus, Bloomberg, Reuters, CNBC, the World Gold Council, Rapidan Energy, the U.S. Energy Information Administration, Business Today, European Business Magazine, and USA Gold have all been referenced as specifically as the public record allows. Verify every figure independently before making any financial decision.